Okay, this is chapter 13, accounting 2. I am just going to hit some of the things that I think are a little more difficult. I'm not going to go through every single thing. What I'm going to do is I'm going to show you some of the PowerPoint slides, kind of talk you through those, and then I'm going to switch to Excel and we're going to do a couple things together so you can see how that works. The slide that you're seeing on your screen talks about the characteristics of stock, and I know that stock is very uncommon for most people, and so this is a whole new territory probably for you. Corporations make money by selling stock to people like you and I. You can buy one share of stock, you can buy 100 shares. It doesn't really matter as long as you have the money for it. When a corporation decides to issue stock, they issue stock certificates. In the olden days, they used to actually mail you a certificate saying that you are the proud owner of one share of PepsiCo stock or whatever. Each share of stock is assigned a par value, and I think the best way to try to comprehend par value is kind of what you think it's worth. I believe that this is $50 stock. This stock is worth $50. Well, as the market fluctuates up and down, stock can be sold for more or less than par, but par is kind of what you think it is worth. All right, the next thing is some stock does not have a par value, but it has what they call a stated value. So if you ever see that in your book, really all that means is kind of the same thing as par, but we're calling it stated value instead of par. And once again, what you believe that is worth. In order to, if you are a common stockholder, here are three things that you have the right to do. You have the right to vote, so you can vote on who is elected to the board of directors. You can vote. A lot of times that's kind of the one thing you vote for, but you can also vote on how earnings are spent. You have a right to the share of distribution of earnings. So what that means is you have the right to receive dividends every year. If the company can pay them, you can receive them. And then the last one is the right to share in assets upon liquidation. So liquidation means if the company is liquidated or it is cleaned out or it's closed out, then you have a right to those shares. And most of the time that's going to be cash. There are two types of stock, and we call those paid-in capital, because that's paid-in capital is the money that you're getting from stockholders. And most of the times, corporations will issue common stock and preferred stock. And common stock has the right to vote, preferred doesn't. So out of those things that I just talked about, preferred does not have the right to vote. Preferred stockholders are going to get their dividends first. So in some years, preferred stockholders may be the only ones who get dividends because there's not enough to go around, whereas in some years, preferred stockholders should get the same amount every year. If there's a whole bunch, common stockholders may get more because they're going to get whatever is left over. And that's kind of what we're going to talk about when I get ready to do the Excel files. So dividends are authorized by the board of directors. They declare those, and then you will eventually pay those out to your stockholders. We have two different types of preferred stock. One is cumulative, one is not. Cumulative stock means that if, let's say I am supposed to be paying my preferred stockholders $14,000, but I only have $10,000 this year, $4,000 of that is what we call in arrears. I couldn't pay it, so it goes into a account, or it's written down as to be in arrears. And if you have cumulative preferred stock, the next time the company has money, you're going to get that $4,000 of back pay that you didn't get the year that you should have got it, and then what you're going to get for that year anyway. So non-cumulative, which is the next slide, well, somewhere in here, sorry. Non-cumulative basically just means that you are not going to get that. You're going to just be out that money. So what I'm going to do now is I'm going to go to Excel, and I just type this up out of your textbook. This is on the bottom of page 586 and the top of page 587. I'm going to walk you through how they came up with those numbers, and I kind of type these up a little bit differently than what the book does, but it basically says that Sandpiper has 20,000 shares of cumulative preferred stock. Okay, so that means cumulative means that I can have money in arrears. I will get back paid for it. All right, it says it's 1% and it's $100 par. That 1%, even if they give it to you when you're selling stock, the only time you ever take into that 1% into consideration is when you're paying dividends. Excuse me. So what that means is that 20,000 shares is how many shares we have outstanding, but only 1% of those are going to get dividends. So if I take 20,000 shares times 1%, I should get $200 or 2,000. No, 2,000. 200. Yeah, I had it right the first time. Sorry about that. All right, so out of my 20,000 shares, only 200 shares will receive dividends. All right, so out of those 200 shares, their par value is $100. So I should be paying my preferred stockholders $20,000 every single year. All right, so in year one, I'm going to make a column here, one for a row for preferred, common, and then if we have anything in arrears. All right, so in year one, I only have $10,000 to distribute. My preferred stockholders are supposed to be getting $20,000 every single year. Well, I don't have enough, so I'm going to give them the $10,000. Common's not going to get anything, and there's going to be $10,000 in arrears. And what I mean by that is that $10,000 in arrears is the amount that I should have paid them, but I couldn't because I didn't have enough money. All right, this is year one. Okay, so year two, it says that we have $45,000 to pay out. Well, my preferred stockholders are supposed to get $20,000 a year, as it's shown up here, and I still need to back pay them. Do I have enough? Yeah. So this time they're going to get $30,000 every year, or not every year, but in year two. And preferred will get what's ever left over. So in order to make up the 45, they would get 15. Now, it's their arrears. That's done now. So that I can, let's see, I'll strike through that. So I can mark that out. All right, year three, it says we have $80,000. Well, my preferred stockholders are supposed to get $20,000 every year, so I'm going to give them that. And then here's where the common actually gets a little more. So they're going to get $60,000 worth of dividends. And these are all dollar amounts. Okay, these are all dollar amounts. Okay. Now, the last piece of that you'll see is your dividends per share. And what I mean by that is how much dividends is each share going to get. So in year one, my preferred is $10,000. Well, I've got $10,000, and if I divide that by the number of total shares. So I'm going to come clear back up here to row 2 and say, okay, that was 20,000 shares. $10,000 divided by 20,000 shares should give you 50 cents per share. Common would just be 0 because they didn't get any dividends that year. Year 2, my preferred, I divvied out $30,000 in dividends, and I had 20,000 shares. That would be $1.50 per share. Common, I had $15,000 in dividends divided by 100,000 shares. That will give me 15 cents per share. All right, you get the gist there. So you're doing dollars divided by total dividends. All right, I'm going to do one more here. Swan Creek has 40,000 shares of 2% preferred stock, $60 par. I am not going to pay attention to this common stock hardly ever, except for when I'm doing those dividends per share. So I'm going to take 40,000 shares, times 2%. That gives me 800 shares. So once again, 2% of 40,000 is 800. So out of my 40,000 shares, only 800 shares will receive dividends. Now I take my 800 shares times $60 par. That equals $48,000. So every year my preferred should get $40,000 in dividends. If I can't, it'll go into arrears. So this is year 1, my preferred, my common, and my arrears. So the first year, I only have $30,000 to give out. So that's all they're going to get. Because they're supposed to get 48, I only have 30. So what does that put into arrears? 18,000. All right, now year 2, my preferred is supposed to get 48. I need to get rid of that arrears too. 48 and 18 is 66,000. Okay, so they're going to get their 48 that they should get plus the 18 in arrears. So my arrears is cleaned out at this point. I'm not going to use that again. Well, I have 90,000 to give out, and I have used 66, so that would leave 24,000 for common. Year 3, I have 48,000 to give out, or that's what I need to be giving out. I have 125 to give out, so I'm going to give out. They're going to get their 48,000. Let's see, 125 minus 48 leaves me 77,000 left to give out to common. So common just gets whatever's left over. And in some years it's bad for them, like in year 1 they just had 0. In year 2 it was worse, but in year 3 they actually got more than the preferred shareholders. Alright, so once again, shares times the percent gives you the number of shares that will receive dividends. After that, you take those shares times the par value. That's how much preferred stockholders should get every single year. If you cannot pay them that, it will go into arrears. Once you can, you pay them that plus the amount in their arrears, and common just gets what's left over. Okay, there's some other things in the PowerPoint I wanted to kind of point out just real quickly. Like I said, there's several other things. I just don't want to go into every single bit of that. The last thing I want to talk about is treasury stock. Treasury stock is stock that the corporation buys back, so it's their own stock. So there's stock that people own out in the market, and they're just going to buy it back from them. And they could do that for the reasons that are shown on the slide here. All right, so this journal entry says that we purchased 1,000 shares at $45. Okay, so it tells you that $25 is the par value, and but we paid $45 for them, and so $45 is kind of like our new par. If we had to pay $45 for them, they are on our books at $45 a share. That is our price for them. All right, so $45 is what our new par value is. So we're going to say we bought treasury stock, so we're debited because it goes up, and our cash goes down because we had to pay $45,000 for these shares. Now, when you get ready to sell them, remember that $45 is kind of your new par value. So it says we sold 600 shares at $60, so that's my cash value. Treasury stock is going to go off the books at par value, its new par value, so 600 shares times $45 gives you that 27. Let me just make sure that's calculate that. Yeah, that gives you that $27,000. And then the paid-in capital is the difference between the two. So just remember on treasury stock, even though it was $25 par when you started, you had to buy it back at $45, so that's your new par. And so I just wanted to point out those two slides. There are some journal entries that I did not go over. Just remember that stock is an asset, so when you get rid of it, it is credited, and it's always credited at its par value. And like I said, on treasury stock, you get a new par value based on what you paid for it. So like I said, there's some other things in there. Those are the kind of things I see students struggling with. So if you have any questions beyond that, please let me know.